Many people start investing with the dream of building wealth, but when the portfolio turns red, showing losses day after day, doubts and fear begin to take over. News headlines talk about market crashes, recessions, and economic downturns, leaving investors wondering what all of it means. Should they panic, buy more, sell everything, or simply close the app and walk away? Before reacting, it's important to remember that many historical market crashes have been the turning point for creating new millionaires. This downturn might be an opportunity to build wealth, but how does one actually take advantage of it? To understand this, one must first know why stock markets crash. A stock market crash refers to a sudden and significant drop in stock prices across the market. These crashes typically occur due to three major reasons: bursting of market bubbles, economic weakness combined with certain policies, and black swan events. The first cause is the bursting of bubbles. A bubble forms when stock prices rise significantly higher than their actual value, driven by hype rather than true company performance. When reality hits and investors realize prices are unjustified, they sell off their stocks, leading to a sharp decline. A well-known example is the dot-com bubble of the early 2000s. The internet boom led investors to pour money into any company with .com in its name, regardless of profitability. At its peak, over 400 internet companies went public, and the NASDAQ index surged by over 800%. But when investors realized many of these companies were not profitable, a massive sell-off occurred, and the NASDAQ crashed nearly 80%, taking 15 years to recover. The second major reason is a weak economy and restrictive economic policies. High inflation causes living expenses to rise, which forces people to cut back on spending. This leads businesses to earn less, prompting investors to lower their expectations and sell off stocks. If this trend continues, it can lead to a recession where economic activity contracts. During recessions, production slows, spending drops, and investor confidence falls further, pushing stock prices down. In addition, when central banks raise interest rates to combat inflation, loans become more expensive, reducing business growth and consumer spending. This can trigger or worsen a crash. Every interest rate announcement becomes a point of concern for investors because rising rates generally lead to falling stock prices, while rate cuts often support a recovery. The third trigger is black swan events. Rare and unpredictable disasters such as wars, pandemics, terrorist attacks, or financial scandals. These shocks can cause widespread panic, and investors may quickly sell off their holdings, leading to rapid market declines. A real-world example is the 2020 COVID-19 pandemic, which caused global markets to fall over 30% within weeks due to fears of economic shutdowns and uncertainty. Though there are additional contributing factors like excessive leverage, margin calls, or herd behavior, the three primary causes outlined above are responsible for most crashes. The next important question is whether stock market crashes are normal. The answer is yes. Markets operate in cycles, experiencing both highs and lows. For long-term investors, crashes are a natural part of the investment journey. In fact, for many traders, market downturns offer valuable opportunities to buy low and sell high. Historically, market movements fall into several categories. Pullbacks, which are drops of 5 to 10%, occur almost every year and are considered normal. Corrections, which are declines of 10 to 20%, happen every 1 to 2 years when stock prices adjust back to realistic levels. Bear markets, with declines of 20 to 40%, usually occur every 5 to 6 years and are often linked to economic slowdowns or rising interest rates. Crashes, which are severe drops of more than 40%, occur approximately every 10 to 20 years, typically triggered by black swan events or financial crises. Despite these downturns, history shows that markets recover and grow stronger over time. For example, the 1973 oil embargo caused markets to fall nearly 50%, but they fully recovered within 7 to 10 years. In 1987, Black Monday saw the market drop 22% in one day, yet it rebounded in 2 years. During the 2008 financial crisis, the S&P 500 fell nearly 50%, but regained its losses in 4 years. The 2020 COVID-19 crash led to a 30% drop in just 5 weeks, but markets fully recovered within 4 months. The pattern is clear. While crashes are painful, they are often followed by strong recoveries. Those who panicked and sold during these downturns typically locked in losses. In contrast, those who remained calm and held on to high-quality investments often saw strong returns. While it's true that past performance doesn't guarantee future results, most crashes are part of a repeating cycle. As long as businesses continue operating, consumers are still spending, and governments take action to stabilize the economy, recovery is likely. However, in smaller or less stable economies, crashes may take longer to recover or follow a different pattern. Concern is justified only when the entire economic system collapses. If businesses fail, banks go bankrupt, people lose access to money, or a country defaults on its debt. These events are extremely rare, but would indicate a more serious and long-lasting downturn. Understanding which crashes are part of the normal cycle and which are not helps investors stay grounded during turbulent times. The next step is learning how to navigate these downturns and potentially profit from them. While it may seem counterintuitive, many investors build long-term wealth during crashes. For the informed investor, market crashes present valuable buying opportunities. One of the most common mistakes during a crash is panic selling. When portfolio values fall, many sell out of fear. However, losses are not realized until the stock is actually sold. A company may be down temporarily, but still have strong fundamentals and potential for recovery. If the investment is in a profitable, well-managed company, there's often no reason to sell just because the market is falling. Staying informed, focused on the long term, and avoiding emotional decisions is crucial. Another mistake is trying to time the market bottom. Some investors wait for the exact lowest point to invest, but market timing is extremely difficult. Many either miss the opportunity or buy too early and face further declines. A more effective approach is dollar cost averaging, investing a fixed amount regularly. This strategy allows for buying more shares when prices are low and fewer when they're high, reducing the impact of volatility and removing the pressure of trying to time the market perfectly. Additionally, investors should avoid buying weak stocks just because they appear cheap. Not all companies recover after a crash. Some go bankrupt or never regain their former value. It is essential to focus on financially strong companies with solid earnings, low debt, and a history of surviving downturns. For instance, Amazon stock traded around $90 before the 2008 financial crisis, but dropped below $40 during the crash. If an investor believed in Amazon's long-term potential, that same $1,000 investment could have purchased more than double the shares. By 2021, Amazon's stock reached over $3,000, resulting in substantial returns. Diversification is also critical. Putting all funds into a single stock or sector increases risk. Smart investors spread their investments across multiple sectors, such as technology, healthcare, consumer goods, and utilities. They may also invest in bonds, commodities, or international markets. For those who prefer a more hands-off approach, exchange-traded funds, ETFs, or index funds provide diversification without the need to pick individual stocks. Another pitfall is FOMO, or the fear of missing out. Many investors follow the crowd, reacting emotionally to news and trends without doing their own research. Even seasoned professionals can't always predict market movements. Understanding what one is investing in is essential. When in doubt, consulting a financial advisor can provide clarity, but it's still important to personally understand the investment. One advanced strategy some professionals use is short selling, profiting from declining prices. This involves borrowing a stock, selling it at the current price, and buying it back later at a lower price. The difference is the profit. While some investors have made billions using this strategy, it carries significant risk and is not suitable for most beginners. In conclusion, stock market crashes, though frightening, are a natural part of the market cycle. History shows that most markets, especially in stable economies, recover and reach new highs. No one can predict the future, but evidence suggests that recovery is likely unless there is a complete economic collapse. The key to navigating a crash is to stay calm, avoid panic selling, invest in high-quality assets, and maintain a long-term perspective. Those who stay disciplined and take advantage of discounted prices often emerge stronger after the crash. When the next crash arrives, the best response may not be to fear it, but to prepare for it. Thanks for watching InvestingFlix. If you found this video helpful, Don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.